This is the panel where we're going to talk about illiquid assets. Most of the day, we're going to be talking about assets which are fairly liquid and tradable. But as we know, the crypto world is trying to tokenize a lot of stuff, including illiquid assets. And so John Piotrowski is going to be our moderator. He's the CEO and founder of Ocean. And John, maybe you can start out by just explaining to us what we mean by tokenization in this context. And then maybe introduce yourself. Tell us a little bit about what you do.
Sure. And thank you, Howard and Nick, for arranging and everybody for joining. So as Howard mentioned, my name is John Piotrowski. I'm co-founder and CEO of The Ocean. The Ocean is a non-custodial, instantly settling trading platform for illiquid assets. And so the question is, why would anyone be doing this, especially myself? So my background is I used to run different trading desks and asset investing platforms at Goldman Sachs for 5-6 years. And that's how I originally got into the crypto space, was thinking about, from piggybacking off some of the discussion from earlier, how do we bridge this new world and sort of this understanding, whether it's through crypto or other fintech companies, that maybe traditional financial services need some improvement. I think even people working in financial services in the old world would admit that. How do you bridge that world to the old world, which has certain structures in place for a particular reason? And so one of the ideas has been talked about for years in the space has been, outside of liquid assets and the potential to rethink forms of payment and currencies, Bitcoin or other assets, things that are traditionally illiquid, whether that's real estate, climate finance, IP rights. Can we use the infrastructure that we're collectively building to tackle problems that traditional financial services really never had a strong solution for, at least in a way that was cost effective or maximally useful for folks? And so that was the genesis for the Ocean. And to solve that problem, I think it's not going to take one company. It will take a collection of individuals to make that vision a reality, and hence why we're having this panel and why I invited two colleagues are tackling different parts of this problem to share some thoughts and hopefully some wisdom at the same time. So let me introduce the two other panelists for this next session. So first, Darren Wolfberg, accomplished entrepreneur in fintech, former BNP Paribas MD, former Baycrest, which is a broker dealer and introducing broker based in New York, and is now CEO and co-founder of Blockchain Triangle, which is a Bermuda-based digital securities platform. And Darren can give a description of what he's doing there. And then let me also introduce Bob Kramich. Bob is also a successful entrepreneur and more from a technology background and electronics background, maybe way before his time. I just learned yesterday he used to run an electronics exchange for big electronics companies in the 90s, which is almost a 20-year predecessor to what we're talking about here. I think would have been a lot easier if we had some of the technology.
He's the real
today. So it's great to have both of you. And I wanted to, kind of kick off this panel twofold. One, give you each the opportunity to introduce yourselves a little bit more and what you're working on, but also just to start maybe by talking about what you see as the value prop of asset tokenization, this idea of enhanced liquidity and for things that typically haven't had enhanced liquidity in the past. And why your particular backgrounds have led you to tackle the problems that you are. Maybe starting with Darren, if you don't mind.
Thanks for that, John. Well, great to meet everyone, and thanks for Howard and Doon for putting on this great event. So Blockchain Triangle was formed about 2.5 years ago, and we've been really focused on commercializing a unique piece of tech at the intersection of smart meters and IoT devices and their integration into the securitization of an asset. And really, when I think about the world, you've got $450 trillion of assets, pre-COVID. 165 trillion dollars of those assets are tradable securities, which means that there's $285 trillion of assets that are not part of the financial services ecosystem. And for us, when we look at it, one of the largest segments of that is the infrastructure market, which is littered with private placements, inefficiency. So when we're thinking about, our go-to-market and how we're looking to identify that piece of the pie, we're looking at the climate finance market because we're connecting investors that are ESG minded with a real problem that needs to be solved in the next 5 years. So that's how we're looking at the world and what we're doing to commercialize that software that we're building. Thanks, John.
Yeah, that's I think climate is. I think a lot of times when people think of asset tokenization, they're thinking about these big clunky infrastructure-like investment opportunities. Where in the historical world, you would have need one person to write a big check effectively through some private placement to get something done. Bob, you're working on slightly different angle. I almost call it sort of a new asset type of persona and IP. Do you mind giving an introduction and talking a little bit about it?
Yeah, thanks for having us here, John and Howard and Doon and Darren. Thanks for inviting me. It's a pleasure to be here. Yeah, I'm coming at it from a different perspective than I think you guys. I'm looking at it more from a micro transaction perspective than maybe a macro. And really I founded Blockchain Made Easy LLC a few years ago with the pure focus to make blockchain easy for business. As you mentioned before, I was leading this exchange in the 90s. We were trying to bring all this offline liquidity online. We're trying to bring market participants into this exchange, and we failed miserably. But I carry a lot of those principles with me. And when I found blockchain and its ability to verify, transfer, and enforce the transfer of intellectual property rights, I sort of figured, I think I found the key. And when, as a trader, at heart, whether we trade, financial instruments or semiconductors or gas grills, really, it's about supply and demand. And when I realized that, hey, wait a second, so we can create our own supply and we can limit that supply, and we can, and then people within certain types of communities where those supplies may have value can exchange those assets. That's really what's driven us. And so we're looking at things like, reward points as a form of currency in a sense. It stores value. It's a medium of exchange. It's a unit of account. All the three things you need to have to be classified as money. And so Bitcoin, in a sense, has all three of those, right? I think it's probably its biggest handicap until recently has been sort of maybe the unit of account and how many people are using it in that sense across the world. But that's changing. And so what we're doing is we're really helping athletes, professional athletes, manage what IP rights they have across their multiple personas, be it a charitable persona or a sponsorship persona or a gaming persona or a biometric persona, the data associated with their biometrics, and really hoping that they can leverage those assets they have to do other things, maybe outside of athleticism or sports. So that's sort of what we're doing.
I think the way you just described it, the way I've always thought about it too, and especially coming from that bank perspective is, if you take a step back and you look at this underlying rails system or plumbing, there are native cryptocurrencies, Bitcoin, et cetera, that sit on it today. There's no reason in theory that you can't put anything that has value on that sort of rail system and that sort of architecture. And I think that's sort of the idea behind this asset tokenization. I'm wondering, if both of you might touch a little bit on, just to put a little more meat on the bones, if you have sort of a deal or an example, something concrete that maybe you're working on or you've seen in the space, I think that would be helpful before getting into, I think something that folks have talked, this has been an idea that's been around for a while, but hasn't fully developed yet. So of course, interested in bottlenecks too, but I thought maybe we'd start just from a deal perspective. What are some of the things that you're seeing or working on as potential examples?
Yeah, so I mean, from a climate side, we probably have a pipeline of half a dozen different deals. We partnered with one private equity firm to acquire a 6 megawatt asset in Bermuda. It's called the Finger. So that's one asset. We're looking to fractionalize the ownership of that to local Bermudians that want to support the renewable and sustainability industry there. And one of the opportunities there, when you have consumers that are paying 42 cents per kilowatt hour for power, and you can deliver solar sub 8 cents, there's a lot of economic incentive to do that. And I think what we're seeing is not only that project, we've got another project in Australia. It's starting off as 5 megawatt solar parks with batteries connected to them. And part of this sold to an offtake agreement for power purchase agreement, the PPA. And then some is arbitraged through the battery and the spot price of energy at that moment. So that's growing from 5 solar parks to 27 solar parks. And then we've got other opportunities in other jurisdictions in the Caribbean, in Long Island, in upstate New York. And really, we're trying to get these first deals to market so people can see, how do you touch it, feel it, smell it? What are the benefits of it? And one of the things that we're most excited about, when you think of a mortgage-backed security as an example, and you've got your securitization, you got all the 1,000 of mortgages that roll up into that securitization. Essentially, all we need is the smart meter information and the PPA information, and we can securitize 10 of these subscale assets into a larger securitization. It's one last point that I'll make before handing off to Bob. When you think of the cost of capital, when you're $100 million asset or above, there's tons of capital for you. Macquarie, Ontario Teachers, Case to Po, they have all the 5 to 6, 7% capital that you want. But once you start to get lower, when you're a $75 million project, a $50 million project, a $25 million project, that cost of capital starts to go through the roof, because your capital sources are private equity capital sources, and they're looking for those low to mid-teen return profile. What we're able to do is fractionalize that ownership, tokenize it, and bring that cost of capital lower. So there's administrative and cost of capital benefits for this ecosystem as it matures.
That was very interesting. I would add from where I'm working in the world. One is you guys have heard of CryptoKitties and Dapper Labs, terrific company that's doing some stuff, obviously leading in this space. I read that a digital cat was sold for $172,000. I mean, I don't know about you guys, but I really don't have a need for a digital cat for $172,000, but some people do, and they like it. It's about preferences. Then there's NBA Top Shot, which, $100,000 memory being auctioned off recently, and things of that nature. And you've seen all this stuff sort of in real time. For us, we're working with pro athletes and their agents and some charities right now on a project called Athlete Chain, for lack of a better description right now. The name may change, but it's really designed to enable an athlete and a charity who need a lot of help right now to do things like authenticate and move digital NFTs between themselves so that they can benefit not only themselves, but also the charity. And then when you look at what's happening in college sports, and the last point I'll make, for us, where the NCAA is about to allow, pretty much every college, every 180,000 Division I athlete to monetize their own image and likeness, there's going to be an opportunity for athletes to create live events, maybe a live training program in their backyard, working with a partner called Told right now in these kind of environments where, you could put on a live training session for auction off 10 tickets. You don't have a big yard and you want to have a live event and you want to auction them off and split the money with a charity. There's things like that you could do. And people are interested in these kind of things, from digital signatures or digital memorabilia to virtual events, live events of different kinds. I hope that helps a little bit from where I'm coming from.
No, I think so. I always come back to data as well. Just talking about the marketplace for data and how do companies monetize that in some way. An interesting use case there, and obviously climate finance with the emphasis both in the U.S. and around the world of moving towards more renewable sources. That's going to be critical use case, and like you said, Darren, there are, particularly for smaller projects, a lot of these renewable projects tend to be smaller scale, where maybe certain traditional sources of capital might not be as good a source, an interesting opportunity. So it sort of begs the question to me always of, I think some of the use cases, I think people you can get behind. I think the concept of enhanced liquidity, better settlement, less operational risk, people can get behind. So $1 million question is, why hasn't this happened already? I think this space has been talked about, or this idea has been talked about, since 2017. There's been some success stories, but curious to get your thoughts on why, both of you, why it hasn't proliferated, and what are some of the bottlenecks that you see out there still in getting this done?
Yeah, so look, I just want to touch on the data aspect real quick, because one of the areas that we're seeing one of the greatest amounts of traction is really on the asset manager side. So when I think about what wasn't in place 2 or 3 years ago that is becoming in place today, first is the plumbing. So the ability for traditional finance participants to use leverage, to use securities lending, which are part of their daily toolkit today. If they're unable to use those things, that's just another gating factor for that adoption. But touching on data, when we're a lot of the participants that we're talking to from the investment side are the insurance companies, because they not only want to assess the performance of their asset, they want to assess that data so that they can price risk better when they're offering out insurance contracts, and that essentially will lower the cost for insurance as well. But speaking of that gap and the lack of plumbing that was not there before, however, is making its way to be there now, are some of those tools that are just household tools. There were no digital asset ATSs that were approved 6 months ago. Now you're starting to see more digital asset ATSs come to market. And I'm super excited about the interchange between DeFi and ATS, because that's really the onboard into a regulated ecosystem for secondary trading and issuance.
Darren, maybe you should just explain what an ATS is for those that don't know.
So an ATS is an alternative trading system. And basically, in traditional finance, they're known as dark pools. So dark pools came onto the scene, back in 05, 06, 07, and essentially have been a place now where you have these pockets of liquidity that are hidden from the world, however, are accessible to institutional participants. Now, what you're able to do with an ATS is instead of listing on a traditional exchange, ATSs are the lowest barrier to on-ramp onto an exchange. And really what I see is, and no different than in traditional finance, you can have one ATS that's run by Goldman Sachs, and you can have another ATS that's run by Morgan Stanley. And what they do is they connect each other together to create a larger pool of liquidity, which ultimately lowers the transaction cost for that investor. So that's what an ATS is. And this will be the first on-ramps that you'll see from an exchange perspective in the traditional world.
Thank you.
Sure.
I think that was very interesting. Also, I look at this in a sense like back in the way, in the sense that finance adoption drove and the need to trade stocks drove the maturation of the internet and adoption of the internet. I see it happening again here, albeit in shorter cycles, where finance is sort of driving the adoption of mass tokenization, right? And in a sense, being that the cryptocurrencies, the Bitcoins and the public cryptos are sort of driving the adoption of the permissioned world, which is really where I'm falling, right? Permission blockchain. And so there's a couple other things too, which is, one, blockchain's confusing, permission blockchain, for a lot of the people that we're talking to, businesses, right? It's a constellation of legacy tech, encryption, cryptography, algorithms, secure messaging, it's really all old stuff, just assembled in a custom way each time. And that takes a lot of time for people to get their arms around. And then finally, I just say, until, we've had this company for 3 years and, we have a product, we've hit many milestones, but until the pandemic really hit, right? And until sort of, all the political unrest, and plus the combination of blockchain's differentiation over the internet, those 3 macro trends, I think really driving and fueling what we're witnessing right now.
So last question or thought then, what do you see as sort of the next frontier, hurdle, first killer app for this space? I think there's sort of this, people were less excited about this idea maybe 18 months ago, and now with sort of an additional institutional influx, general crypto bull market, climate finance, there's lots of forces pushing. What do you see as the next leap forward here?
I mean, for me, you know, the crypto industry has matured a lot over the last 3 and 4 years. You know, you had your early adopters that got in very early, and you've seen the mainstream adoption of crypto. And I am just excited for this next chapter. So I think this next chapter will be stable coins, and central bank digital coin adoption. And really just after that, because, you know, one of the barriers that was in place was that the banking system the OCC would not allow you to use stablecoin as a mechanism of transport, as a value transport. That has changed. And I think, you know, stablecoin 2021 will be the year of stablecoin. And I think that next gateway of crypto transforming to tokenization, I'm waiting for the Coinbases, for the Fidelity Assets of the world, to come into the market and start offering product that their customers are used to consuming. So, you know, putting together a REIT for solar installations, putting a REIT together for toll roads. Those are all products that are here. And we're excited to get our first demonstrations in market. But, you know, we think our timing is good because the market still needs to mature a little bit. The plumbing still needs to mature a little bit. But we're super excited about this transition, you know, turning the page from crypto only as a tokenized environment to, you know, assets as a tokenized environment as well.
I would say that we are in such an exciting time right now. In a second, what Darren said, that there are going to be so many killer apps, John. In my mind, I lay awake at night just thinking about stuff that we could be doing that we're not doing, that God would drown if we tried. But if you look at the $400 to $600 billion sports industry globally in sports rights trading, whether it's sponsors and leagues and teams and players and agents, there are so many pockets of liquidity, right? Buyers and sellers in that ecosystem where you could create really cool apps that really just simple multi-party consensus apps that if you do it the right way and you pick the right blockchain networks that you're working with, you know, you're not going to paint yourself into a corner, but yet you could unite with all these other apps through blockchain. And, you know, by getting your consensus rules, you know, aligned very easily. So I just think it's a tremendous time for entrepreneurs, and there's going to be a lot of killer apps, especially in big markets. And I think, like a lot of things, like there'll be a lot of fragmentation, and then there'll be a lot of rolling up and uniting of things like we've seen in the past. But that's what I see.
John, can we wrap it up?
Yeah, I think that's a good, you know, ending point. I mean, I think the only, you know, the color I'd add too is that, you know, I think, Darren, to your point on stable coins, it's a process, right? Like it's, you know, you can't go from 0 to 100. There's this sort of intermediate steps. Mm-hmm. And I think it's very clear that where maybe 3-4 years ago, you know, the value prop from a traditional financial service perspective, which at the end of the day still manages the majority of money globally, the jury was still out on whether this experiment and DeFi and some of these other things could actually work. Yeah. And now you see actually it working. And I think maybe you said in a prior conversation, I think that stable coin idea is a good one where, you know, both sides sort of meeting in the middle, right? You know, part of it is regulators, traditional financial services, you know, coming to the table, and part of it is, you know, DeFi protocols, stable coins, your Coinbases of the world, helping build some of these on-ramps and playing nice in the sandbox with some of these other traditional players to bring more people in the space. So I think because that perspective too has changed, we heard about it a little bit this morning. There's still some smoothing of those frictions that needs to happen, but I think there's general commitment on both sides to make it work where it wasn't necessarily there before.
Yeah, I couldn't agree more, and I'm looking forward to it.
Same.
Thank you, John.
Hey guys, this was a great discussion. Thanks so much for stimulating opening of the window into tokenization of hard assets and illiquid assets.